So morning, ladies and gentlemen. So when I was approached for this talk today, the initial thought was, we'll just come out with a market presentation on what we think on the markets are headed for, and kind of be done with it. But I had a chat with Mr. Brajesh, where clearly, the idea was not to talk on markets, but in terms of experiences and what equity as an asset class holds for us. So to start with, I'll just start with my journey here. Thanks for the background in terms of my experience with Sundaram, but I joined equities in 2001, right at the start of the so-called bear market. And I joined the first day. We used to cut pizzas at our office when we had a 10-point move in Nifty. So that was the state of market in 2001, where Nifty was at 1,000, 1,200, and every 10 point used to be celebrated big time in the office. And looking back across 3 cycles in the market, I think clearly one of the very basic facets which equities has displayed is, longer term thinking is something which pays off, and it pays off very decisively compared to what we experience in terms of shorter term movements in the market. So I'll just take you through some of my experiences and what we do as a process for long term wealth creation, which I think is important to understand, because from a fund management perspective, what you would experience is typical NAV movement in the funds, but behind that, what goes as a process in terms of selecting stocks, what is that we try to do in terms of approach to investments, and typically the kind of disciplines which one should have to kind of create wealth sustainably. That's something which I thought I'll take across today. So this is the typical emotions which typically everybody undergoes. There's always a fear on seeing every price action, and obviously there's a temptation when you see a uptick in the market, and likewise every attraction is always also followed by a sense of withdrawal when we see adverse price movements. And why is that, and what kind of typical questions we kind of run across our mind? The common question that we used to get in the last 1 year from some of the new set of investors who've been in this new cycle around is that, I never made money in the last 5 years except for the pre-election run. So that's one refrain that we get. And the most recent one of a set of investors who've come in the last 2 years is that, I've been here in the market since 2015, April, March, I have not grown anywhere, I have not gone anywhere. And in fact, I've lost the opportunity which fixed income had gave me in these 2 years. That's the typical feedback we get from every set of new investors who come in a new cycle. But what is that one experiences if he stays put over a period of time? So when I say over a period of time, the graph that you see on the right is nothing but at least a holding period of one cycle, which is upwards of 3 years. So we have a data right from 1979 running in terms of Sensex and Nifty from 96. In simple max, any holding period above 3.5 years, the probability of an investor losing money in a plain vanilla diversified fund is close to 0. So that explains what this asset class holds in terms of the downside if the longer the period one holds. And in between 1 to 3 years, what does it hold for an investor? You can be, it's like a binary event, it's like a coin toss if it's 1 day holding period, and if it's 1 month, it's slightly better than a coin toss. Your probability is upwards of 60%. But longer the period you hold, lower is the probability of one ending with a negative experience in the markets. So emotions will drive the markets in the short term. That's something, we've seen so many cycles in the past. But as we expand the holding period, that's exactly where, number one, we tend to forget the markets when we have a holding period longer, and typically wealth gets created when you forget equities. That's one. And second, it does tend to put our emotions under check. So once we've seen a palatable wealth under a kitty, we tend to digest shorter term movements much more than what we do when we have a first set of investments done in equity. So that's the backdrop which I want to start off with, and these are some interesting data points which I wanted to share in terms of why this holding period needs to be longer, and just ripping through data, what have we experienced in the past. So this data, what we have is available, and anybody can pull it out and do the max, but the outcome is pretty interesting, where we say that, look, if one had held it for a 5-year period consecutively since the inception of Sensex from 1979, there has been only 3 periods in the last a period of 23-year block of 5 years where one would have had a little bit of negative experience in terms of markets, which means you're looking at a probability of less than 10%. And on the other hand, what is that an investor has scaled up in terms of his wealth by being in the market for a block of 5 years at any starting point between 79 to now? I think the maximum would have been 53%. And likewise, these are all CAGRs. So likewise, as you extend it to 10 years and 15 years, the data becomes even more stronger in saying that your probability of one ending up with a wealth destruction shrinks even more. And okay, the question is fine. I know that staying long term gives me wealth, fine. But what is the range of returns? The next question is, what is the average one earns out of the market in each of these periods? Depending, it's easy to say, let's not time the market. Time in the market is more important than timing the market. But to prove that, let's look at the data. If one looks at the data from the same 23 years of 5-year blocks in the market from 1979, clearly you're looking at 3 out of 28 occasions where your compounded returns in terms of CAGR is less than 7%, which is the third block there. So again over here, if you look at a pure probability perspective, 90% of your occasions, if an investor has not taking the timing aspect of entering the markets, the ability of the investor to have a compounded return upwards of 7% is 90%. So that's the max which data suggests in terms of being invested in the market without trying to time the market and have the discipline of staying there for a period of at least 5 years, which is a cycle typically we see in a business. So the whole takeaway here over is that it emphasizes remaining long term in the market. It emphasizes not trying to time the market to perfection. You might be lucky once, twice, but at the same time, not too much of importance to be attached to timing the market. And third, the volatility kind of subsides as you extend your period. So this is something which I thought I'll kind of stress upon before moving into what equities has done as a basket compared to alternate asset classes. So in terms of, so this is again a data which is there to see across asset classes in terms of absolute returns versus relative returns. We know that markets have been giving double-digit returns in the past on a compounded basis across time frames, and versus any other asset class, this has been a kind of a proven instrument to beat inflation consistently over a long-term period. So I, obviously, as an investor, I wouldn't like to miss this as an asset class, but the key thing is what goes behind creating that wealth in the asset class. So we know equities is a nice space, long term is fine, volatility will reduce, you're going to have sustained returns which beat inflation time in and time out. So that's something which we can appreciate through data, but the key is what creates that wealth. What is the process one needs to have to approach markets? Do I just pick stocks? Do I pick stocks through a process? Do I have a discipline of making my decisions coherently each and every time I see a business cycle playing out in the market? What is that which creates wealth, which is proven to be asset class, giving us wealth sustainably? So that's something which I thought would be the crux of the discussion today. This is just a starter saying that equities is a space where one needs to be here for a long term, and it's an instrument which beats alternate classes and inflation sustainably. So let's look at this chart. This is something which typically matters when looking at what is the upside possible from the market. Before we go into the process, one of the underlying drivers in the markets which we keep kind of telling is that emotions do impact market in the short term, but it's eventually the fundamentals, which basically means your earnings and cash flows of companies, which drive prices in the long run. So in the last 15 years of data, we've seen market exhibit strong phase of earnings growth as an aggregate. All these are aggregates for Sensex as a basket. So we've seen Sensex as a basket grow earnings at 20% CAGR in the bull cycle of 2002 to 2008. We had a pause between 2008 to 2016 where the market earnings growth was 6%, and currently the call that we are making is that we are now back to a phase where earnings growth is going to be upwards of 15-16% to the minimum if our base case is playing out right, and probably something more if, like what the previous speaker mentioned, if the rates were to plummet in a much more faster fashion. Equities love it. Equities as an asset class love falling rates, and it gives a huge kicker to the earnings of these companies when rates fall much more quicker than expected. So the view here, what we are putting out is there is a 17% CAGR of earnings expectation currently built in, and if one has to draw a corollary to what was the phase which was similar to this, it's something very similar to what we witnessed in 2002 to 2008 period. It was exactly a phase where we saw a booming debt market in terms of bond yields plummeting, and that set the base for equities to roar in the next 4 years. So the cost of funds is one of the most important variables for every company to have a couple of decisions, large decisions banked on, right from drawing board decisions for a new project to right from financing your working capital for growth. Each and every decision banks on the cost of funds, and that's one variable where we are seeing the markets heading clearly lower. So falling interest rates is going to be a plank on which we are going to see equities come back even more faster than the last 5 years. And clearly it's a it's a period where you would see some of the companies which are small companies becoming larger companies, and larger companies now getting into the next leg of growth. So this is just a slide to show what should be an expected return from an investor perspective if this thesis plays out, and you have a table below saying, okay, at these valuations, what is the upside? So on a base case of 16 PE, which is where the median markets are, an investor expectation should be geared for a 20-22% CAGR. But should there be excesses in the market, clearly that will be the upside which would play out. So let me just take you through the phase of 2008 to 2016. The common feedback is that, okay, we are in a bull market. What happens if we enter into a phase of 2008 to 2016? So equities will do well, that's fine. But in terms of stock selection, what we end up in terms of what we witnessed in 8 to 15. So the point here is, beyond equities as an asset class, what is relevant is how do we approach stocks in terms of selection. So this slide is just to show that we've had stocks which are multi-baggers across market cycles. It's not about 2003 to 2008 market or 2008 to 2012 market or 13 market. Every cycle has thrown enough number of businesses which are small businesses to start with, but eventually end up as larger businesses. And we're not talking of one or two companies as an outlier over here. You have a dozen companies in each of these cycles. So just to take you through 2003 to 2008, if you were to look at it on a space of 850 stocks in the market, the top 850 stocks in the market, you had close to 400 companies which were multi-baggers. When I say multi-baggers, these are businesses which grew upwards of 2 times to 5 times, and there were 150 companies which were 10 baggers. The value which was created was 10x. That was a clear phase where it was a discovery phase in the market. Investors latched on to equities right at the time of 2003. A lot of the undervalued businesses were discovered, and you had a growth element coming in. 2008 to 2013, despite a crisis worldwide in terms of layman, despite of we had a scam in 2010 which hit a lot of sectors which were linked to it, and despite the so-called policy paralysis in 2010, 11, 12, here is a list of 200 stocks, top mid-cap companies within the 850 basket of stocks, which were multi-baggers of 2 to 5x. So what does it boil to in terms of wealth creation? We know the space equities, it's about approaching the space with a disciplined idea of selecting stocks on certain metrics. So the process matters in terms of how do we create wealth. The space is clear. So coming to the process, you need to have a process where you are able to judge cycles much more faster ahead of the market, and at the same time stay put until the cycle plays out completely. So the chart here is just to drive the fact that you will have in each and every cycle certain businesses gaining strength on that cycle and certain businesses losing strength. It's about the ability to judge which are the ones which would capitalize on the cycle playing out and staying put in those cycles. So from this perspective, how do we build a portfolio if we have to have a stock selection framework in mind and kind of identify certain multi-baggers? So it's a simple chart here. It's a typical bookish chart which any MBA finance grad would see on his second year in terms of portfolio construction. You have 2 stocks in a portfolio. One stock compounds at 25% CAGR, and the other one loses at 25% CAGR year after year. and if you have a portfolio of just 2 stocks with 50% allocation to each of these stocks, the outcome after a 10-year period is that your portfolio returns will start converging towards the stock which is a winning stock in your portfolio. And the reason is very simple. The positive contribution which you get from compounding wealth in a winning stock typically tends to outweigh the delta which is created by a stock which pulls down your wealth. So it's all about having a set of winners in a portfolio where you're able to compound wealth by staying put in them and without trying to slice and dice anything in between. That gives you the ability to kind of outweigh even if there are anything which you have in terms of negative aspects in a portfolio which tends to pull you down. So just taking this cue, there is a small table here. I know it's a bit cluttered in terms of market movement in terms of Sensex between 2010 to 2015. You had so many phases of market of 2-year, 3-year buckets. If you look at it, market was flat. So 2010 May to 2012 June, 2 years market was flat. Absolutely, nothing home to write about in terms of markets. What has active stock selection done to a portfolio? So that's the table on the right, where the column on the right, where you will have as a proxy, we've taken our mid-cap fund as a proxy. But if you were to look at what the fund has done in a phase of market where markets are perceived to be doing nothing, you will have 8 out of 10 occasions where active fund management has created alpha. So just to take you through an example, 2010 to probably, if you were to look at the first one, which is like your 2012 period, markets were flat, your fund had a 2% alpha. And the same way between 2014 to 2016, which is even more, reflective because we had an election outcome at that point of time. 2014 to 2016, the 2-year period after election, market was flat at 24,000 Sensex or 23,000 Sensex. And you had a mid-cap fund which had given you a 20% alpha compared to the markets. So headline markets move based on the underlying set of stocks. What matters to a portfolio is the stock selection and the process for stock selection. So the idea of this table is to showcase that if you are in the right set of businesses and if you have the conviction to back them, irrespective of the underlying, there is the ability to create wealth out of the opportunities which these businesses can capture. So currently this is a table which just showcases what process that we approach, we have in terms of stock selection, and is something which every funders would have in terms of approaching businesses. But the whole underlying thesis here is that it's something which is consistently followed as a process. So every fund house would have an investment team consisting of certain sector champions. You will have typically anywhere between 6 to 10 analysts. You will have an economist. You will have a fund management team. But the idea is that these sector champions, when they are able to identify certain business cycles, that's something which gives the insight to have early moves into certain businesses and stay put with those businesses through a cycle when it plays out. So what is that we typically follow in terms of identifying these businesses? There are enough more than this in terms of the slide that I've put out as to what are the filters we apply. Broadly, 3 things which matter is what is the business about in terms of growth, what is the business about in terms of scalability. Okay, it's a nice business to be in. For example, if I were to look at auto as a pack, okay, auto 2-wheelers, it's a nice space to be in, but within 2-wheelers, which is a segment which is going to do well? Is it your 4-wheelers or within auto, which is going to be 4-wheelers or 2-wheelers, or within 2-wheelers is going to be a aspirational segment like a Royal Enfield segment, or it's going to be a typical Hero Honda segment? It's about understanding those business dynamics very closely as to where the growth is coming in, what is the sustainability of the growth, and how fierce is the competitive intensity, and what are the typical moats which businesses have around themselves. So that's something which, as a filter, one has a framework to apply on. And second, which is more important, is the management. When I say management, the capital allocation decisions, what companies have done in the past do matter when one makes an investment decision. There are enough examples to say that when a company sees a good cycle, they tend to earmark their cash to a new business which they would never have even charted in the earlier history. So what does it do to an investor? Clearly, it puts the investor back. So these are the decisions which one goes through before making a call whether the management has exhibited reasonable capital allocation prudence in the past. And thirdly, in terms of minority shareholders, how well have minority shareholders been treated? Has there been any instances in terms of minority shareholders being taken for a ride? So these are filters strictly applied, which each and every fund house goes through, or any asset manager would go through to have that sustainable wealth creation. So let me just take you through what we have. We say at our fund house, when you say, okay, we have an investment framework, what is it about? So we call it a 5S approach, where we say it has to be a simple business where you are able to understand it. You know what are the nuances of the business, what can hit them right, what can hit them wrong, what is that will give a surprise to the business. Scalability, like what I said, how is the growth coming in? 2009, people wrote off Royal Enfield as a brand, as a company, and today we know where it stands. So what went into that? Clearly, there was a aspirational segment which was coming into the market. People were uptrading in terms of their lifestyle. You had the two parallel trends which were happening. Number one, even in your four-wheelers, you had people migrating from your typical, your Wagonars to your Desires, and Desires started moving into SUVs very slowly. And likewise, in two-wheelers, you had economy giving place to your executive, and executive giving place to your, super premium. A category was getting formed because of the aspirational aspects, and this was a brand which was a cult brand, where they started capturing that through a new engine launch in 2009. So the opportunity was a scalable opportunity because it was a new segment opening up, and there was a massive demand coming in, and the space was vacant. So that's something what we look at when you look at scalable. How much this growth is going to long last? Is it the longevity of the growth is what matters in terms of scalability. Third, promoter, like what I said, what has the promoter exhibited in past in terms of management bandwidth and capital allocation decisions. Fourth, sustainable competitive advantages. Each and every business tends to create value when they build moats around themselves. So moat, when I say, is it's a jargon, but it's about having an edge over the others. We've seen some of the companies which are mid caps today and which were small caps earlier. The strength is either in the form of the distribution or brand, or in the form of being early into the space where there is a technology element involved. So what is that which can give them that ability to kind of keep hold of the advantages in terms of profitability and return ratios over a longer period of time? That's what is typically looked into in terms of sustainable advantages. And lastly, one single line, profits is fine, but cash flows, are they there? So cash flows matter much more than the profitability, and that's something which every investment manager would go into. So it's a framework that we have, and every fund house would typically have a framework like this in terms of stock selection. So some of the examples what we experienced in the past. So this is one company which which used to be a relatively unknown name in 2003, 4, 5, called Fact Bearings, and it's a typical dirty auto ancillary business as it was conceived sometime back, a decade back. Auto ancs used to be untouched in the market. There used to be low PE stocks with investor interest dominated by the OEMs. But what was this business offering from an investor perspective was that this segment is not easy to penetrate. Here is a player who was well entrenched in the space from a supplier perspective. So he had his relationships very much there. He had a barrier to entry in terms of his technology from the parent. So that's something where it matters in this space, especially in case of bearings, which are critical part items in the OEMs. So he was able to increase his market share year after year as the park of cars in the country started growing up. So he had a market from the OEMs, which is your Marutis and the Hondas, giving him business year after year. And on the other hand, replacement wise, every replacement cycle after the 5th year, he started seeing his business balloon out of it. So as a stock perspective, if one had looked at his business model, it was a business of 20% return ratios, debt free, high margins, high relationships, entry barriers in the form of technology, and look at what has it done from a shareholder perspective once it got discovered. So you had a clear wealth creation of 3x above what the market had done over the last 5 years. So markets is all about identifying these businesses, get positioned, and when the discovery happens, you have a multifold return than what a broader portfolio would do. So that's where a stock selection comes into the picture, where you need to be a bit ahead of the curve. Just sit tight on it, and if one had not sold a single share in between, I think the wealth creation is clearly way above what a normal diversified index would have done. Likewise, I mean, this was again another name which was typically known as, a company which was, it's a Delhi-based company, and there was a inhibition when this Kyoto Protocol came into picture in 2008-9. But here again, a classic case, the company used an opportunity to morph itself into a specialty chemical player. They had a technology in terms of fluorine chemicals, and look what it has done to a shareholder once people started appreciating the strategy behind this company. They scaled up in a span of 3 years. They used their cash flows prudently in a space where they had expertise. And lastly, from a shareholder perspective, they never exhibited anything in the past in terms of capital allocation being misallocated. So this is again a clear example which we experienced, where staying put for a 3-year period where the strategy is right, the space is exciting, and here is a company capturing that space through a change in approach. I think that's paid off brilliantly in the last 3 years. So this is pure bottom-up approach where you go do the grind work in terms of identifying stocks, identifying businesses, and staying put with them. Alternate, there are enough asset managers who also have a top-down approach. When I say top-down, they try to identify macro trends. Macro trends is something where they try to identify secular trends in the market. These trends don't die of a quarter or a year. They tend to stay long for a period of time. So some of the trends that we see today, for example, is consumer finance. Consumer finance is something which 5 years back was not as big as what it is today, and our view is that it will be much more bigger than what we see today. The reason being, it's a trend which has just caught up. India used to, when we say India mein financial services used to be just banks. Banks, corporate banks, ICICI, Axis, all corporate heavy banks used to be what we call as financial services. But in the last 5 years, we've got a new segment coming up which was not fully tapped by the traditional banking system, what we call as a consumer finance space, where we are seeing a larger trend evolve. So what are these trends? So number one, this is a space where you are seeing aspirational buying come in. When I say aspirational buying, the income levels have gone up. So typically the global standard is that anything above $1,500 per capita, the guy doesn't spend the incremental money in the same basket. He tends to allocate to a discretionary space which was aspirational for him earlier. So that trend is picking up. We've seen the surge in SUV sales in the last 3 years. We've seen the surge in Royal Enfield sales. We've seen surge in air conditioner sales. It's one industry where we've seen growth despite a downturn in the last 4 years, so-called downturn, air conditioners or refrigerators, whatever we see as in terms of sales numbers as an industry, there is a growth which is at a disconnect with what we see in terms of overall economic growth. And the simple message in that is that these are trends where people are starting to have aspirational items coming into their basket of purchase. So gone are the days where you used to have 1 AC per household. Today you're looking at centralizing, or you're having 3 per household. So the metrics are changing because you're seeing income levels moving up and you're seeing aspirational buying coming in. So this is a trend which is coming in. It's a 5-year trend. It doesn't die off. So what has it done to the stocks? So we know the classic story of Bajaj Finance. He built a book of closer to 10,000 crores just out of a segment called consumer durables. And this used to be sub 1,500 crores 5 years back. So that's what these kind of companies have captured in a space which was exploding. And for that, there are certain capabilities which need to be built around, which obviously they have been doing it. So from a stock perspective, this was one outlier in the last 5 years for the simple reason that they were spaced in a segment which was exploding, and they used the entire capability to capture it. So this is what, when we look at longer term trends on a top down basis, is the trend there? What is the growth rate? And are there companies to capture it? So what is the market opportunity today in terms of consumer finance? If we are going to still look at a 5-year trend playing out, what is that one should expect as an investor looking at this segment? Put together all private banks and NBFCs today, it's all about a market cap of $175 billion. That's where they are. If the view that we are going to be in benign interest rates for the next 4 years is holding true, if the view that we are seeing aspirational buying to continue is going to hold true, this space can grow at anywhere upwards of 18%. We've already been growing at 15% in the last 5 years. It just takes one cut in rates for people to explode in terms of aspirational buying. And from an opportunity perspective, these are the companies which typically capture it. So compared to a $175 billion market cap, if you're able to grow at 18% CAGR over a period of time, your target should be looking at anywhere closer to $600 billion over a period of time. So businesses multiply manifold when the underlying segment explodes. So this is an example of a top-down approach where you know a segment is doing well just by the right name with capabilities and good management around themselves, which has a business moat in terms of model, and you have value to capture. So process of selection matters here overall, whether it's top down or bottom up, or whether I have a blend of both. End of the day, you need to just have the discipline of doing it consistently year in, year out. So again, this is a product just to showcase what a consistent approach would have done in the past. You know, this is one of the earliest products that we had in our fund since 2002. Year in, year out, if we had observed what we had done as an investment approach, the product today showcases what is the investor experience in this journey with our mid-cap portfolio. So the idea is you have each and every fund house in the market with which are older products which has been through two or three cycles in the market, where a consistency would have paid off. So just look at the power of an SIP for an investor who forgets doing direct equities, but he has put in his basket of money with an asset manager who can show consistency in terms of investment. So an investment of 10,000 since our launch in 2002 would have been 17 lakhs, which basically means you're compounding at 26% year in, year out. So that's what consistency pays in terms of investment approach. It's not about timing the market. It's not about trying to be slicing and dicing your portfolio anywhere in between. It's not about trying to make your entries and exit precise at the point of a top and a bottom. It's about having an investment framework, be it top down or bottom up, and have the ability to kind of do it repeatedly in terms of following that approach. And the idea here is that today an investor has multiple options. An investor in equities can look at passive investment, buy the benchmark. I don't care about the markets, but I just buy the benchmark Nifty index through an index fund. I can buy actively managed funds in the mutual fund space. I can look at funds which are growth oriented, funds which are based on value investing. So there are plethora of options for an investor today, but the underlying bottom line is that each of these approaches has a framework. There are enough players in the market who've made also money by chasing momentum, and they've done it brilliantly in terms of having a discipline of doing that day in, day out. People who follow charts and say, okay, fine, I'll do that when certain triggers are happening in the market. It's all about doing it in a very consistent manner. So that's in terms of what options an investor has. But from an approach perspective, the little message which I wanted to leave out is that equity is a space where you have defined wealth creation, and it's all about looking longer term, having a discipline of doing it regularly. And at this point of time, when we look at markets where they are in terms of the rate expectations, in terms of growth expectations, the view that we've been putting out is that you will have shorter term aberrations, but it's a fantastic time to wet your feet in the market. Typically 3 months down the line, smart investors tend to look through what's one time and what's recurring in nature. Clearly in the next 2 months, when each and every investor has a perception of what demonetization is going to do to this company, this set of sectors, you will have repercussions which are 1 month, which are 2 months, but investors will look through it if they get a sense of what is one time and what is recurring in nature. And typically the best money is made when there is blood on the street. That's when when you wet your feet and you see that the market kinds of looks through it after a period of time, you have a massive delta over and above what you have in terms of normal wealth creation. So I'll leave it here in terms of the market expectations, what we think is playing out. We clearly are looking at this opportunity in the market as a space where one should use it prudently in the next couple of months, and it's a phase which is far more exciting than where we started the year, especially given the way rates have started playing out. And I've never seen, at least in the last 3 cycles, where equities hated falling interest rates. So with that, I'll stop here, and any questions you can feel free to ask.
Thanks, Bharat, for throwing light on equities.
You talked of SUV.
Yeah.
it is believed that it's more cash buying, or let's say people who have surplus cash or unaccounted cash.
Yeah.
Now that's cash being sucked out,
Yeah.
and it's more like plastic money. Do you think the high-end cars will continue to grow?
See, from high-end auto perspective, you will have short-term disruptions in the market. The disruptions are unavoidable because there is a mindset change which is happening currently, and it takes time for the psyche to change. So I don't think we are looking at a phase where high-end discretionary consumption, be it physical assets or something like high-end auto, comes back in a hurry just because there's a new currency in the system. There is a psyche change where it will take time for people to digest it. But the one little data point which I wanted to share again is that we are getting into a clear phase where traditional banking is getting disrupted. So the chart over here was just to show that we are seeing the new set of consumers lapping onto a mobile banking directly compared to the age-old practice of opening a bank account, doing a branch banking, net banking, and coming in. So the velocity in which people used to trade through the banking system, our view is that it's going to expand manifold, and that's what somebody like Paytm has been reflecting in the last 2 years. Apparently Paytm has connected close to 6 lakh plus vendors in the last 2 years, which is twice than what State Bank has done in its history. State Bank is connected with 3 lakh odd vendors, and HDFC is from 3.2 lakhs. So there is a disruption in banking. So for high-end consumption perspective, it's going to take a backseat for the short term, clearly. But what we see is that this trend, what we see in terms of digital banking coming in, that's going to have a much more faster push. And from a transaction perspective, we're already seeing that this is the first year where digital transactions have exceeded physical transaction in India's history. So that will continue to be much more faster. To answer your question on physical assets and high-end consumption, I don't think it's going to come back immediately in the next quarter. It will have its own time to come back.
Yeah, Bharat, excellent presentation. Thanks. You have emphasized the the issue about identifying cycle.
Yeah.
And cycle, at what point of cycle do you
Yeah.
get in and get
Yeah.
out?
Yeah.
Is going to make a difference.
Yeah.
For example, if you go to your fag chart itself,
Yeah.
if somebody instead of on the last, let's say on 17th or 18th year that he was getting out and getting 943,
Yeah.
if he had got out 5 years earlier, possibly
Yeah.
would have made
Yeah.
2,000
Yeah.
times.
Yeah.
So what are the factors in your mind that one should be watching for to decide, okay, now this is the cycle is down and therefore it'll go up, and what is the time to exit?
Yeah.
At what point in
Yeah.
time in the cycle you should be trying to look at getting out? I mean, I'm
Sure.
not looking at
Got it.
dots,
Yeah,
but I'm
but
looking
leave
at
something on the table and get out.
Yes.
Yeah. So we split the businesses into two sections. One is businesses which are inherently cyclical, like your sugar to your some of your commodity companies where cycles typically are experienced with a defined time frame. It depends on, for these businesses, supply comes in with within a time. You see new capacity coming in, a new supply coming in, like in the case of sugar and steel. Steel, we know it's a 4-year cycle where if there is a boom in the market from the time of consumption to a new plant coming in within a 4-year period, one can reasonably assume that at the end of 4th year, one should look out for new capacities or the signals for cycle to turn around. So in cyclical businesses, it's far more easier to judge cycles or come closer to an exit point where you have you'll know companies which have paybacks of less than 1.5 years. The cycle would be like, for example, in case of sugar, what we are experiencing, the profitability will be so high, it looks like money for jam in terms of somebody putting in, based on current profits, it looks like a payback of 1.5 years. By the time he comes with the capacity, obviously profits would shrink. So in case of cyclical businesses, it's far more easier to have that exit points timed in terms of getting out once money has been made reasonably well. In case of non-cyclical secular businesses or businesses which have been growing steadily but could come to a standstill, there are a couple of things what we try to track in that. Like in case of FAG, for example, there are two things. One is we try to look at the business drivers in terms of what is driving that particular strength of the business. Say in case of FAG, you had two components. One is a OEM component, one is a replacement component. OEM component is, which is your supplies to your four-wheelers, is vulnerable to your interest rate cycles, the consumer sentiment when it gets hit because of a rate movement fast. One has to be prepared for a volume shrinkage or incremental volume growth being tepid in that particular space for a period of time. So over that, at least you'll have a grip on what is that which drives the OEM growth, which will take, so when we look at FAG, when in terms of how they are going to grow, 18% growth rate comes from 12% from four-wheeler growth in India or 11% from four-wheeler growth in India, and your replacement growth, which is anywhere between 5 to 8%. So that's how one broad basis is estimate of how these companies would grow. This 12%, which is a chunk of its growth, is it vulnerable? Yes, it is vulnerable because of certain factors like interest rates, consumer sentiment, and if there is a threat of new entry to that OEM, which we don't think, at least in case of FAG. So over there, in case of names like FAG, I think there are two exit points which we typically look at. One, like the structural part of the growth, which is the OEM growth, is it at risk, for which you have a couple of indicators. And second, the price that you pay, is it discounting growth beyond what these guys can deliver. So for example, you can always work out what is the implied expectations in the market from the price and say whether it's from a fund manager perspective. I have a view that this company can grow at 14%, and I can draw from the market at a current price saying what is the market implying in terms of growth rate. If there's a serious disconnect, obviously either I am wrong or the market is wrong. So you take a call on that. So it is that exercise of reviewing your assumptions month in, quarter out, which makes you, experience through mistakes obviously, but you get to that pulse of leaving something on the table and getting out if there's a disconnect. So the way we look at it is typically we do a reverse implication from the market price. If a stock like FAG is trading at 4,000, what is the growth it's implying versus my assumption of the growth, for which I have a skeletal model in terms of what gives that 12% growth. So if there is a disconnect, I need to review it and I need to take a call whether if I believe that I am right and the market is too optimistic, I quit from it. So that's what typically investment managers try to assess in terms of their assumptions versus the markets. What are the markets telling? In the phase of 2008, 9, 10, when it was a cheap stock, where we believe this is a cycle which is going to be playing out, we had growth estimates far higher than what market was implying at that point of time. But clearly, we tested our convictions through our checks. So, which is where you need to do you need to have a support system in terms of having on the ears to the ground in terms of checking certain sentiments in terms of dealers, vendors, OEMs, what exactly is happening on the ground. And obviously, if we are right and markets are wrong for that period, markets tend to come back, which is what happened in the last 3 years. So it's always one basis is investment based on a certain set of assumptions and tries to validate his assumptions versus what the market is implying and takes a call whether he is right and whether he needs to get out or get in more. So that's how, it's an art, it's not a science to be fair, but one makes a reasonable move in terms of the direction.
Thanks so much, Bharat.
Thank you. Thanks for your time. Sure.
One last question. We are all under the assumption that interest rates will go down.
Yeah.
But is there a flip side to it, that with this demonetization, there will be a lot of NPAs which will show up, and banks actually may have a problem to solve?
See, there might be NPA issues in certain pockets. End of the day, when you're looking at the banking system as a whole, on an advanced book of 72, 73 lakh crores, obviously there is a 1.5 lakh crores of exposure towards high-end loan against property. So that's anybody's guess today as to what exactly would be the outcome in that segment in terms of NPAs. So is it vulnerable? That segment is vulnerable, yes. But from a trend perspective, the last 3 years as an industry, what we've been seeing is that savings towards the financial system is ballooning. What we've seen in the MF industry in the last 18 months or 2 years is, as a pool, is much way higher than what we collectively had in terms of inflows in the previous 8 years. So to that extent, the savings pattern in terms of financial instruments is a trend which we are seeing clearly playing out. of which equities is one of those assets which is having its share of wallet, and insurance is one which has come back. So we are not seeing the deposit growth getting abated in the short term. We don't think that will abate in the short term, and on the other hand, credit growth will pick up only when you hit a certain threshold level. So even without demonetization, the inherent pressure towards a rate cut has already been building, because your deposit growth has been outpacing credit growth consecutively for 4-5 quarters successively now, and it on its own is putting pressure for the system to transmit more rates. So this trend, I don't think it's going to get disturbed in a hurry. NPAs, yes, it might happen in certain pockets, but at the same time, today the system is, I would say, far more cushioned to absorb it than in 2013. So to that extent, your CASA is getting built by the banks in a much more faster fashion. So it's a situation where we think financial savings is increasing, and of which one of the vehicles has been equities, which has been massively benefiting out of it.